Welcome back. You're watching India Tonight. I'm Shibani Gharat joining you from Mumbai studio, and I have with me my colleague Sumita Karir joining us from our Delhi studio. Now, ahead of the budget presentation, the economic survey for 2026 will be tabled in the parliament tomorrow. The survey will give an official snapshot of what Indian economy will look like. This policy document will outline the government priorities that will shape the fiscal policy for the year to come. So a lot to look forward to what is happening tomorrow, Sumita.
Absolutely, because the key macroeconomic numbers will be watched, and the key macroeconomic numbers that will be watched out for tomorrow are going to be the real GDP growth projection for FY26 and beyond. Inflation trends is another segment that the economic survey is going to touch upon, sector-wise performances and outlook for exports and services, especially in the face of tariffs from the United States. Well, those are some of the key expectations that we have. But what would these numbers essentially mean, and how will the government maneuver in India's growth story? We discuss it with our experts today. So joining us to discuss this is Gaura Sengupta. She's the chief economist at IDFC First Bank. And joining Ms. Sengupta is Mr. Devinder Pant. He's the chief economist at India Ratings. Thank you very much, Mr. Pant and Ms. Sengupta, for taking the time out and speaking to us here on ET Now. We've spoken about a whole host of expectations, but what is it that you're penciling in? We'll take the first comments from Ms. Gaura Sengupta on tomorrow's big expectations. What is it that you expect the government to essentially speak about? What is going to be the key focus area? Is it going to be more of a cautionary tale, or will there be optimism in the speech that will be delivered on the economic survey?
So first of all, thank you for having me. We definitely will be looking at the growth numbers for FY27 to get a sense what is the government's estimate. Our sense for FY27 real GDP growth is somewhere around 7%. The survey tends to give you a range, so maybe they'll give you a range somewhere centering around the 7%. Though new base GDP will also get released, but we do expect that broadly it should be another strong year from a growth perspective. In terms of focus, I think the survey will focus on areas where we have really been seeing a little bit of pressure. One is the fact that reviving private CAPEX. We've not yet seen a strong revival in private CAPEX. The support to the CAPEX cycle has been the center and state capital expenditure. And the other point of struggle has been the lack of capital inflows. We have seen a sharp slowdown in FPI outflows currently. And in terms of FDI, though we are attracting gross inflows, we are losing majority of those inflows in terms of repatriation as well as ODI. And hence that pressure on the INR is basically the fact that we are not getting capital inflows. We also recently had the labor reform. I think that was quite a significant development where the government of India has simplified the labor laws. Again, that will be another touch point of the economic survey, how to generate jobs, how to broaden the formal sector, incentivize firms to scale up. And lastly, there will be definitely focus on the export sector and how to deal with the tariff issues on the trade front.
As well, and over to you, Mr. Pant. Just today, we saw a strong 7.8% IIP growth data coming in. So IIP data coming in. So growth and robust capital expenditure. The economy has clear momentum, as we can see. What single critical, crucial reform, according to you, that you believe that economic survey must outline tomorrow to translate this, infrastructure-led growth into a more, let's say, broad-based and sustainable, consumption recovery as well?
Good evening. So you want me to address what will be the more key reform which economic survey will touch upon, or you are looking at through that reform the budget? Because both are the two different things. If you look at in the past over whatever 3 decades or 4 decades, it is unlikely that the measures or the prescription given in the economic survey will find a place in budget. because economic survey is nothing but a technocrat, which is the chief economic advisor, and his teams advise to the government on the state of economy and what kind of measures are required to lift economy from whatever phase that they are in, economy is in, to a sustained growth path. So when we talk about that, so we may be looking at, as you rightly said, how the consumption demand, which is the story for FY20 for this fiscal year growth, how this can be sustained. What are the measures and steps required to increase investment in the economy, because we are getting investment and it is not broad-based. You may find a lot of detail because India is signing a lot of FTAs. Yesterday we had India-EU FTA, the custom
Absolutely.
duty reform, because they are long pending overdue. Because if you want to have more and more FTAs,
Right.
more and more with more countries, then we have to have custom duty reform. The survey will
Right.
talk about health, education, the
Absolutely.
softer aspect, physical infrastructure. People talk about physical infrastructure, but one of the major obstacles is the social infrastructure. So you may talk about that also.
Absolutely. Mr. Pant, let me ask you a follow-up question. You brought about this aspect of trade deals, and just yesterday we clinched a mega mother of all deals with the European Union. However, there is still some time before those deals actually come into effect. The UK deal might come into effect this year, but definitely the EU deal is coming into effect next year. So that volatility or that strain as far as these external factors are concerned, that is going to remain on the Indian economy. But other than geopolitical risks, what are going to be the large risks that the economic survey is going to touch upon?
Look, economic survey, certainly the tariff, or whether you say the geopolitical or mainly the tariff risk which Indian economy is facing. It may talk about how the measures which are required to, again, as I said, to put economy in sustained growth path. So the risk emanating from the fiscal side, because what we are looking at 2 consecutive years of the nominal GDP growth touching sub 10, and all of us know the fiscal deficit respond more to the revenue rather than expenditure compression. We can't do expenditure compression. We have been doing on the current account. Current in the sense the revenue expenditure, CAPEX is increasing, but since right now the fiscal glide path has moved away from the fiscal deficit to GDP ratio to the debt to GDP ratio, which government was expecting to touch 56.1% this fiscal, which is likely to be marginally higher than that. How that is going to take place? Unfortunately, one of the key things on which a lot of things depends, which will not find a place in the economic survey tomorrow. What are the recommendations of the 16th Finance Commission? Because that will decide on how much devolution will be shared with the states, whether the cess will continue to be shared with will not be shared with the state, or whether there is a change of thought that cess will be shared with the states. Because this report will see the first result or broad outcome in the budget. Then what is not expected, like, look, all of us are talking about, Gaura talked about 7%, we are at 6.9%, broadly similar, most of us are around 7%. But that number will become meaningless by end of February. Because suddenly you will look at a number, you will look at a size of the economy, which is much bigger than what we are measuring it right now.
Sure.
Chances are that two points quickly, you will look at the growth pattern being stronger than what we had seen right now, and you will see the current low inflation phase may show a higher inflation because the weightage of food, which is negative with inflation, is deflation, has a larger weight, that weight coming down. So you may not see 0.5% or 1% kind of inflation by end of February. And the moment those two numbers are there, everything will go back on the drawing board stage.
Absolutely. Now, let's also quickly take Gaura Sengupta's inputs on the FTAs as well, because, you know, India is keeping the FTA momentum alive over the past couple of weeks, couple of months, in fact. So on FTAs and like a mitigating strategy, because you also spoke about FIIs. So how critical will, you know, the successful execution and also utilization of some of these FTAs be in structurally narrowing India's trade deficit and creating a sustainable non-debt creating, you know, like foreign currency inflow that will inherently strengthen the, you know, the currency going forward?
I think the FTAs, you should see from a long-term perspective, it's not going to generate any sort of a solution to what we are facing, the challenges that we are facing from the US market. Because right now, the EU trade deal is broad ranging. It actually covers merchandise, it covers services, it protects sensitive sectors like agriculture, dairy have been kept outside. It gives Indian industries enough time to adjust to the fact that majority of Indian imports from the EU will have zero duties. But again, that is done over a period of years, giving domestic industries time to adjust. While in the case of the EU, in that case, 90% of the reduction in duties will be effective immediately. So it's a good deal. It helps to create a level playing field, not just for India, but also for EU. But right now what is happening is, if you look at our trading patterns, India's exports to the EU are actually slowing down because there is a slowdown in their domestic growth. So their ability to absorb our exports compared to US, which is growing, is a consumer-oriented economy. Their US consumer has this peculiar trait where even if, let's say, the income growth slows down in the US, they'll augment it by borrowing. That is a very, very US-oriented consumption pattern, which most countries don't share. So hence US is a large consumption market. So in the near term, it may not be enough to basically mitigate the hurdles that we are facing. But over the medium term, it will help make sure that at least our merchandise, which right now 20% goes to the US, gets more diversified. I think more needs to be done for services, where the software services for India, more than 50% just go to the US. That sort of dependence has to be reduced and broadened. And that's what, let's say, deals with other developed countries like the EU, UK should also focus on. The other thing is, for now, the depreciation pressures on the INR, it's not a current account problem. It's actually a capital account issue. The capital account for India in Q3 has turned large negative. As per our estimates, FY26 balance of payments is a deficit of around 20 billion. We are not attracting capital. That is the issue. The trade account is not a problem. So we do expect the economic survey to touch upon how India can actually incentivize FPI investments, also broaden FDI investments, and our ability to retain those FDI investments and increase the rate of return that an FPI or a long-term investor gets when they invest money into the Indian economy.
Absolutely. Absolutely. And FTI investments, well, that is something that the government really needs to touch upon, that the government really needs to focus on. We were hearing for a short while, a couple of weeks back, that perhaps the government could take a relook at investments that are coming in from China. But let's see where that story essentially goes. With respect to PN3. But let me also ask you, particularly with respect to the economic survey, what inflationary trajectory is the survey likely to assume, and will inflation come up as a policy constraint in the coming year?
Is that for me?
Yes, Gaura.
All right. So our assessment of the change in weights is slightly different. So the change in weights that will happen in the new base CPI, there will be a reduction in weight of food. There will be an increase in weight on core. And we'll also have modern services which are not getting captured. For example, quick commerce, that will also get included. So, and also, for example, housing in rural, which was not part currently, will also get included. So next year, what will happen in FY27, because food inflation has crashed in FY26, there's a very big base effect that gets created for FY27. So in FY27, food inflation will go up thanks to the base effect. Core will stay relatively flat. So for FY27, this base change will be beneficial because it's giving lesser weight to food inflation, which goes up, more weight to core. But we'll need to see how things like housing inflation, which have been, we cannot explain the kind of softness that we are seeing on the housing side, because anecdotally, rents have definitely picked up, and that is not matching with what we are seeing in the housing survey. So if, let's say, the housing component, there is a change in methodology that the MOSPI is doing, whether that has any impact, what is the impact of getting, let's say, the rural housing also within the index, and we're also uncertain about the core area, the fact that services will get beefed up, because as you rise per capita income, the consumption of services, modern services, OTT platforms, for example, will get included. Net, our hunches for FY27, it'll have a dampening impact, mild dampening impact, because food gets slightly less weightage and core gets more weightage. And just because of the base effects for FY27, overall headline, there'll be slightly dampening impact. I know you didn't ask about the GDP, but we, the base change, and completely agree with the point that with the new base GDP, the fact the services side will be captured much better.
Yes.
We do expect some upward revision for GDP.
Absolutely.
Forward.
Yes, Ms. Sengupta, thank you so much for giving your inputs and insights on this, and also Mr. Pant, thanks for joining us. I'm afraid we are running a little short on time, but thanks again for joining us on ET Now.